Budgeting on an irregular income can feel like trying to hit a moving target. One month you're flush with cash, the next you're wondering if coffee counts as dinner. The key is creating a plan that works no matter how unpredictable your paychecks are. In this video, we'll break down simple strategies to smooth out the highs and lows, prioritize essentials, and still save for your goals without the stress. Today we will talk about how to budget on an irregular income. So before we start, make sure to hit the like button and subscribe to my channel. 1. Separate business and personal finances. The first and most critical step for anyone with an irregular income is to meticulously separate their business and personal finances. This isn't just about accounting. It's a foundational practice that provides clarity and control. Commingling funds makes it nearly impossible to track your true earnings, expenses, and profitability. By creating a dedicated business checking account, you can funnel all your professional income into one place and pay all business-related expenses from it. This includes things like software subscriptions, supplies, marketing costs, and travel. A separate business account simplifies tax preparation immensely, as you'll have a clear record of all deductible expenses, which can lead to significant savings. It also helps you understand the actual health of your business by showing a clear profit margin. From this business account, you should then pay yourself a salary by transferring a set amount to your personal checking account. 2. Track your income and expenses religiously. You can't manage what you don't measure. For those with irregular income, tracking every dollar that comes in and goes out is non-negotiable. Begin by establishing a system for tracking your income. This can be a simple spreadsheet, a dedicated budgeting app like YNAB or Mint, or even a notebook. Record every payment you receive, noting the source, date, and amount. This will help you identify patterns and understand your average monthly, quarterly, and annual earnings over time. Simultaneously, you must track all your expenses, not just the big bills, but every single purchase, from your morning coffee to your monthly rent. Categorize these expenses into two groups, fixed and variable. Fixed expenses are those that stay the same each month, such as rent/mortgage, car payments, and insurance premiums. Variable expenses fluctuate and are more controllable, including groceries, utilities, and entertainment. By tracking this data over several months, you'll gain invaluable insights into your spending habits. This historical data is the bedrock of your irregular income budget. 3. Create a baseline budget. Once you track your spending for a few months, you can create a baseline budget. This is not a typical monthly budget. Rather, it's a budget based on your essential expenses, the bare minimum you need to live. It should cover your fixed costs like housing, transportation, and debt payments, as well as a conservative estimate for essential variable costs like groceries and utilities. Your baseline budget is your survival number. It's the amount of money you must have on hand to get through any given month, even a low-income one. The goal is to always have enough money to cover this baseline. When you have a high-income month, you first use the extra funds to cover your baseline for the current month, and then set aside enough to cover your baseline for the next 1 or 2 months. This creates a financial cushion or income smoothing fund that acts as a buffer against income volatility. 4. Prioritize your savings goals. With an irregular income, savings are not just a luxury, they are a necessity. You should have 2 primary savings goals, an emergency fund and a future expenses fund. The emergency fund is your first priority. It should contain enough money to cover at least 3 to 6 months of your baseline living expenses. This fund is your ultimate safety net, protecting you from unexpected life events, like a car breakdown or a medical emergency, and it also covers those times when your income dips significantly for an extended period. Don't touch this money unless it's a true emergency. The second fund is for future, planned expenses. This could include things like an annual car registration, a biannual insurance premium, or even a vacation you've been planning. By setting aside a small amount each month from your variable income, you can build up these funds over time, so you're not hit with a massive bill all at once. 5. Strategically handle high-income months. High-income months are a blessing, but they can also be a trap if not managed wisely. The key is to resist the urge to immediately upgrade your lifestyle. Instead, view this excess income as a tool for building long-term security. Follow a clear hierarchy of needs for your extra cash. First, replenish or top up your income smoothing fund to cover future baseline expenses. If you have enough to cover the next 2 or 3 months, you're in a great position. Next, prioritize your savings goals. Put a chunk of money into your emergency fund and your future expenses fund. If you have any high-interest debt, such as credit card balances, now is the time to make an aggressive payment. Paying down debt is one of the most effective ways to free up cash flow in the future. Only after these essential steps are taken should you consider discretionary spending or its splurge. 6. Adjust and review your budget regularly. Budgeting with an irregular income is not a set-it-and-forget-it task. It's a dynamic process that requires regular review and adjustment. At the end of each month, or more frequently if needed, sit down and review your income and expense tracking data. Compare your actual spending to your baseline budget and assess your progress on your savings goals. Did your income meet expectations? Did your expenses stay within your comfort zone? Use this data to make informed adjustments. If you consistently find that your baseline budget is too low, perhaps your grocery bill has increased, it's time to revise it. If your income has been consistently higher than you anticipated, you might be able to accelerate your savings goals or debt payments. 7. Plan for taxes and future responsibilities. For those with an irregular income, especially freelancers and business owners, taxes are a significant and often overlooked responsibility. Unlike W-2 employees who have taxes automatically deducted from their paychecks, you are responsible for calculating and setting aside your own taxes, including federal, state, and self-employment taxes. It's crucial to estimate your tax liability and set aside a percentage of every payment you receive. A good rule of thumb is to set aside 25 to 30% of your gross income, but this can vary depending on your tax bracket and location. Use a separate savings account specifically for taxes to avoid the temptation of spending that money. Making quarterly estimated tax payments is often required by law and helps you avoid a massive tax bill at the end of the year and potential penalties. It's also wise to consider future responsibilities like retirement. With no employer-sponsored 401, you are responsible for your own retirement savings. 8. Use a zero-based budgeting approach. A zero-based budgeting approach can be particularly effective for people with an irregular income. The core principle is that every dollar you earn is assigned a specific job. The formula is simple: income, expenses, savings equals zero. This doesn't mean your bank account must literally be at zero. It means that at the end of your budgeting period, all your income for that period has been allocated. When you get paid, you allocate that money to your baseline expenses, savings goals, debt payments, and any discretionary spending. With an irregular income, you can adapt this by applying it to the money you have on hand at the start of a budget period, which might be a month or even a 2-week cycle. For example, at the start of a low-income month, you'll allocate the funds you saved from a previous high-income month. The zero-based method forces you to be intentional with every dollar, preventing leaky spending where money disappears without a purpose. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.